Welcome, everyone. Today, we are going to break down something super important if you want to understand the stock market better. We are going to talk about how to read the order book. This is a key tool that will help you understand what is happening with stocks in real time. Stick with me, and by the end, you will know how to read the order book like a pro. You will be able to use this to make smarter trading decisions. Ready? Let us get started. Before we dive into all the exciting details, imagine having a tool that lets you see exactly how many people want to buy or sell a stock, and at what price, right in real time. This tool can be your window into the action, helping you predict where the price might go next. That is exactly what the order book does. It is a real-time list of all the buy and sell orders for a stock, giving you a clear view of market demand and supply. Knowing how to read the order book gives you the power to anticipate market moves and make better, smarter trading decisions. Another important part of understanding price movements is recognizing chart patterns. Chart patterns are visual formations on a stock chart that help you predict future price movements based on historical trends. Some common chart patterns that traders look for include head and shoulders, double tops and bottoms, triangles, flags, pennants, wedges, cup and handle, and rectangles. These patterns can be a great way to gauge market sentiment and identify potential turning points. Let us expand on these patterns further. The head and shoulders pattern is one of the most recognizable reversal patterns and is used to signal a change in trend direction. It features three peaks. The middle one is the highest, the head, and the other two peaks are lower, the shoulders. This pattern often appears after a strong upward trend and signals a potential reversal. The inverse version of this pattern, called an inverse head and shoulders, is seen during a downtrend and indicates a potential reversal to the upside. The double top and double bottom patterns are also reversal patterns that indicate market shifts. A double top looks like an M and forms after an uptrend, indicating resistance at a price level that the market cannot surpass twice, leading to a downward move. A double bottom, shaped like a W, forms after a downtrend, showing that the price found support at a level twice and may be ready to move up. These patterns can be quite reliable when accompanied by significant changes in trading volume. Triangles come in three varieties: ascending, descending, and symmetrical. An ascending triangle has a flat top line and an upward sloping bottom line, showing that buyers are becoming more aggressive. This pattern often results in a bullish breakout. A descending triangle has a flat bottom line and a downward sloping top line, indicating increasing selling pressure and often leading to a bearish breakout. A symmetrical triangle shows both buyers and sellers narrowing their range, indicating a consolidation before a breakout, which could go in either direction. Flags and pennants are continuation patterns that signify brief consolidations before the previous trend resumes. Flags are small channels that slope against the current trend, while pennants look like small symmetrical triangles that form at the midpoint of a significant movement. These patterns suggest that the price will likely continue in the direction of the prior trend, and they are often associated with strong momentum. Wedges, like triangles, can signal either a continuation or a reversal, depending on their positioning and slope. A rising wedge typically occurs during an uptrend and suggests a loss of momentum, leading to a bearish reversal. A falling wedge forms during a downtrend and is often considered bullish, as it indicates that selling pressure is subsiding and a breakout to the upside may be imminent. The cup and handle pattern is a bullish continuation pattern that resembles a teacup. The cup is a rounded bottom, and the handle is a small consolidation to the right of the cup. This pattern often indicates that the price will continue to move higher once it breaks out of the handle area. Traders view this pattern as a signal of renewed buying interest after a period of consolidation. Rectangle patterns are formed when the price moves sideways between horizontal support and resistance levels. This pattern signifies a period of consolidation, and traders often look for a breakout in either direction to determine the next move. Rectangles can occur during both upward and downward trends and offer opportunities for breakout trading when the price moves beyond the established boundaries. By thoroughly understanding these chart patterns and learning to recognize them, traders can better interpret market sentiment and make more informed trading decisions. Combining chart patterns with other indicators like order book depth, volume analysis, and technical indicators such as moving averages can further enhance the reliability of these signals and provide a more comprehensive view of the market. Let us go into more detail about these patterns. The head and shoulders pattern is one of the most well-known reversal patterns. It consists of 3 peaks. The first and third peaks are roughly equal, while the middle peak is the highest. This pattern typically forms at the top of an uptrend and signals that the price may soon reverse and move down. Conversely, an inverse head and shoulders pattern forms at the bottom of a downtrend, indicating a potential move upward. A double top or double bottom is another common chart pattern. A double top looks like the letter M and indicates that the price tried to rise twice but failed at the same resistance level, suggesting a downward movement is likely. A double bottom looks like the letter W and suggests that the price has found strong support at the same level twice, which could lead to an upward reversal. Triangles are continuation or reversal patterns that come in 3 types: ascending, descending, and symmetrical. An ascending triangle has a flat top and rising bottom, which usually indicates that buyers are gaining strength and the price is likely to break upwards. A descending triangle has a flat bottom and falling top, often signaling that sellers are gaining control and the price could break downwards. A symmetrical triangle forms when both the top and bottom trend lines are converging towards each other, indicating a period of consolidation. The breakout from a symmetrical triangle can occur in either direction, depending on market sentiment. Flags and pennants are short-term continuation patterns that form after a sharp price movement called the flagpole. A flag is a rectangular pattern that slopes against the prevailing trend, while a pennant is a small symmetrical triangle that forms after the flagpole. Both patterns indicate that the price is taking a brief pause before continuing in the direction of the original move. Wedges are similar to triangles, but both trend lines are either rising or falling. A rising wedge is a bearish pattern that occurs in an uptrend, indicating that momentum is slowing and a reversal to the downside is possible. A falling wedge, on the other hand, is a bullish pattern that forms in a downtrend and suggests that the price may break higher once the wedge completes. By combining the information you get from the order book with these chart patterns, you can improve your timing for entering and exiting trades. For example, if you see a head and shoulders pattern forming while also noticing large sell orders stacking up in the order book, it could be a strong signal that the price is about to drop. Similarly, if you see a double bottom forming and large buy orders appearing in the order book, it might indicate an upcoming price increase. Spotting these patterns takes practice, but once you get the hang of it, they can be an invaluable tool in your trading toolkit. Chart patterns do not always work perfectly, but when used alongside the order book and other indicators, they can help you develop a more complete trading strategy. Let us break down these patterns a little more. The head and shoulders pattern consists of 3 peaks, with the middle one being the highest. This is a sign that the price is losing momentum and a reversal might be coming. A double top looks like the letter M, and it indicates that the price tried to rise twice but failed both times, suggesting a downward movement. A double bottom, which looks like the letter W, suggests the opposite, meaning that the price may soon move up after failing to go lower twice. Triangles come in 3 types: ascending, descending, and symmetrical. An ascending triangle shows higher lows, meaning buyers are pushing the price up, and it is usually a bullish pattern. A descending triangle shows lower highs, where sellers are pushing the price down, often indicating bearish sentiment. A symmetrical triangle means the price is squeezing into a tighter range, and it can break out in either direction. Flags and pennants often form after a sharp move in price, and they show a brief period of consolidation before the trend continues. Wedges are similar, but have sloping trend lines that indicate a tightening price range. Rising wedges are usually bearish, while falling wedges are often bullish. By combining the information you get from the order book with these chart patterns, you can significantly improve your timing for entering and exiting trades. For example, if you see a head and shoulders pattern forming while also noticing large sell orders stacking up in the order book, it could be a strong signal that the price is about to drop. Similarly, if you spot a bullish pattern, such as an ascending triangle, while seeing a surge in buy orders, it may indicate that the price is likely to break upward. Another example is recognizing a double bottom pattern, which signals potential upward movement, and confirming it with increasing buy orders in the order book. The same applies for continuation patterns like flags and pennants. If these patterns form after a sharp upward move and you see strong buy orders persisting, it suggests that the price could continue higher. Spotting these patterns takes practice, but once you get the hang of it, they can be an invaluable tool in your trading toolkit. It is crucial to remember that chart patterns do not always work perfectly. There can be false breakouts and failed reversals, which is why it is important to always confirm what you see with other indicators, such as volume and market depth. When you use chart patterns alongside the order book, volume, and other technical indicators, you can develop a more complete and robust trading strategy. This layered approach helps reduce risk and gives you a better understanding of the market dynamics, making your decisions more informed and precise. Now, let us talk about how the order book is set up. Imagine a list that has 2 sides. On one side, you have all the people who want to buy the stock. They are called the bids. They show the different prices people are willing to pay. On the other side, you have the sell orders. These are called asks, and they show the prices people are asking for to sell their shares. The order book does not just show you the best price to buy or sell. It shows you all the price levels that buyers and sellers are interested in. This gives you a lot more information about the market than just looking at the current price. There are a few key terms that you need to know to understand the order book. One is the bid-ask spread. This is just the difference between the highest price someone wants to pay for a stock and the lowest price someone is willing to sell for. When the spread is small, that means lots of people are trading and it is easier to buy or sell quickly. But when the spread is big, it can mean fewer people are trading and the price could move around a lot more. Another important term is market depth. This means how many buy and sell orders are stacked up at each price level. If there are a lot of orders at different prices, that is a deep market, and it makes the price more stable. If there are not many orders, the market is shallow, which means the price can swing around a lot more. You will also see different kinds of orders in the order book, like limit orders and market orders. Limit orders sit and wait for a specific price. Market orders are filled immediately at the best price that is available. Alright, so how do you read the order book? It starts with understanding the best bid and the best ask. The best bid is the highest price someone is willing to pay. The best ask is the lowest price someone will accept. Together, these two prices tell you the current quote for the stock. Next to each price level, you will see how many shares are available at that price. If you see a lot of shares at a certain price, that can mean there is a lot of interest at that level. This interest can often represent significant support or resistance points. Support levels are areas where there is substantial buying interest, meaning traders are willing to buy at that price, and it helps to keep the stock from falling below that level. Resistance levels, on the other hand, are areas with a significant number of sell orders, which can prevent the stock price from moving higher. By carefully examining these levels in the order book, you can identify where the price might struggle to move beyond, either up or down. Additionally, watching how these levels change over time can provide even more insight. For example, if a previously strong resistance level suddenly has fewer sell orders, this could indicate a potential breakout where the price may rise higher. Similarly, if a support level is starting to weaken with fewer buy orders, it could signal that the price might fall further. These movements can often align with common chart patterns, such as double tops or double bottoms, and when confirmed by changes in the order book, they provide strong trading signals. It is also helpful to recognize clusters of buy or sell orders, known as order book depth. A deep area of buy orders is often a sign of strong support, while a deep area of sell orders can signal robust resistance. These clusters can also tell you about the overall market sentiment. If buyers are becoming more aggressive, pushing their orders to higher price levels, it shows bullish sentiment. Conversely, if sellers are pushing their orders lower, it can indicate bearish sentiment. By understanding and combining these signals, you can gain a more nuanced view of market behavior and better predict potential price movements. The order book can help you figure out where the market might go next. If you see a lot of buy orders sitting just below the current price, that can mean the price might not drop much further. On the other hand, if there are lots of sell orders sitting just above the current price, that might mean the price will have a hard time moving higher. By watching how the orders are changing, you can get a sense of whether there is buying or selling pressure in the market. Let us talk about order book imbalances. Sometimes you will see way more buy orders than sell orders. That is called an imbalance, and it can be a big clue. If there are lots of buy orders and not many sell orders, that might mean the price will go up soon. If it is the opposite, with more sell orders, the price might go down. Spotting these imbalances early can give you a head start and help you make better trading decisions. But just like anything else, the order book is not perfect. One big risk to watch out for is spoofing. Spoofing is when someone places a big order to make it look like there is more interest at a certain price, but they do not actually want to buy or sell. They might just want to trick others into thinking the price is about to move, and then cancel their orders. It can be tricky to spot this, but one way to protect yourself is to not rely just on large orders. Watch to see if the orders disappear quickly, and always use other indicators to confirm what you see. Now, the order book is really useful, but it works best when you combine it with other tools. One of the best tools to use is volume. Volume tells you how many shares are actually being traded. If you see a big order in the order book and also a lot of trading volume at that price, that can mean it is a strong price level. You can also use technical indicators like moving averages, which can help you confirm whether the price trend is real or just a temporary blip. If you are going to use the order book to help with your trades, here are a few tips that will help. First, pay attention to the key price levels. These are the prices where you see the best bid, best ask, or large orders just above or below the current price. These levels can tell you a lot about where the market is likely to move next. Also, keep an eye on sudden changes. If a big buy or sell order disappears all of a sudden, it can mean that the market sentiment is shifting. Finally, remember that the order book is most helpful for short-term trading. It can help you make quick decisions when you need to. There are also some common mistakes that people make when using the order book. One of the biggest mistakes is overreacting to every small change. Just because an order appears or disappears does not always mean that the price is going to move. It is important to wait for some confirmation before you act. Another mistake is forgetting to look at the bigger picture. The order book is just one piece of information. You should also consider other factors like market news or trends. And do not focus only on the big orders. Sometimes the smaller orders that are moving quickly can tell you more about what is really going on. If this is all new to you, do not worry. One of the best ways to get better at reading the order book is just to practice. If you can use a demo account, that is a great way to get started. You can practice reading the order book and making trades without risking any money. It is also a good idea to keep a journal of your trades. Write down what you saw in the order book, what you did, and what happened after. Over time, you will start to notice patterns and figure out what works best for you. You might also want to try using the order book with different kinds of stocks. A big stock like Apple will have a very different order book than a smaller company, so it is helpful to see how they compare. So let us recap what we have talked about. The order book is a real-time look at all the buy and sell orders in the market. It tells you a lot about the supply and demand for a stock. By understanding the bid-ask spread, market depth, and watching large orders, you can get a sense of where support and resistance might be. It can help you predict market movements and improve your trading. The more you practice reading the order book, the more you will understand how the market works. And always remember, use other tools like volume and technical indicators to help confirm what you are seeing. I hope this has given you a good introduction to reading the order book. It might seem complicated at first, but once you start practicing, it gets a lot easier. If you have any questions or thoughts, be sure to share them. The best way to learn is by discussing what you are seeing and getting different perspectives. Thanks for being here, and I hope you are ready to dive in and start practicing.